Welcome to our panel, What's Driving Institutional Adoption of Crypto? And I don't know about you, but I've been to the CAC, I think, for 5 years now, and sometimes it feels like Groundhog Day. Everybody's talking about the institutions are coming, retail is coming, and sometimes you have to have a very strong faith to see what's happening. And this is why I'm so glad that the panel today, we have everyone from a pre-2020 crypto veteran in a digital asset bank to a true crypto native who survived every cycle, plus 2 experts helping institutions turn curiosity from the institutionals into conviction. In other words, if you care where digital assets go next, these are the people that you want to talk to. Let me just quickly introduce them. Martha brings nearly 2 decades of emerging market investing experience to the digital asset world. And at Fidelity Digital Assets, she helps institutional investors understand why this market matters and how to understand it intelligently. Welcome, Martha. Let me just check. Then it's Lutz. Lutz helps build the bridge between traditional finance and digital assets at Sygnum, the world's first digital asset bank. You may sound very TradFi on paper, but your personal crypto experience goes well back before it became fashionable. So welcome, Lutz. Moving on to Adrian. Adrian, you spent your days turning crypto market chaos into an investment narrative. I think that's fair to say. Making sense of what happens. I'm very curious what you have to say about current development. As chief investment strategist at 21 Shares, you are one of the people shaping how institutions can make sense of what's happening in crypto. And last but not least, welcome, Mäx. You've been in crypto since 2011, which probably makes you prehistoric. And I would say you lost all your hair about it, but who am I to judge? Today you're a CPO at Teroxx, and you're building a kind of regulated infrastructure that could make digital assets feel like the real asset class for serious people. Now, before I start with the questions, I would just like to hear from you on a scale of 1 to 10, where do you see your institutional investors today? Just, you have 2 hands, just raise your hand. What's their appetite for what's happening at the moment?
You mean on average?
So what's the, just give a number from 1 to 10.
I mean on average, because
yes.
I have to say
absolutely.
it's a heterogeneous group. I would say we're about 4. I want to say 3 or 4.
Okay.
Being biased of Martha saying 4, I was going to say 7, but now I'm afraid I have to go with 6. So
okay.
Okay, I go lower. I say 2 out of 10, because globally there's barely any discretionary portfolio that has a crypto sleeve. So we're still at the very, very beginning.
Yeah, I agree with this too, especially in Europe. I think the appetite is still pretty low, and we need to do way more groundwork, especially from an adoption perspective.
Well, ladies and gentlemen, this is quite surprising, because usually everybody will shield their own product. So welcome to a really honest panel here. We have 4, 6, and we have 2 2s out of 10. Maybe Adrian, let me start with you. You've described crypto, Bitcoin, and crypto is increasingly macro-driven. What macro variables matter most in 2026? Liquidity, rates, the dollar, fiscal policy, the ongoing war. What drives prices? What drives institutional appetite?
I would say from all the ones you named, liquidity is the most important one. Bitcoin is a liquidity sensitive asset. Of course, it's more complex, and it depends on the broader macro environment, what's going on geopolitically. Real yields, are they finally coming down? But if I want to pin down one, then it's definitely liquidity that matters for the price of Bitcoin.
Anybody agree or disagree with that? Martha?
Yes, I would agree with that. I mean, in the reports that we've worked on, we consistently find that over longer time frames, Bitcoin is very linked to M2, whether it's US M2 or global M2, both very highly correlated. And this is something that institutional investors can understand quite easily and relate to, because this is very much a part of their framework.
Okay. Maybe Martha, on this, did you want to, okay, just on this point, the institutional investors have always cried for regulation. Now we have a regulation with MiCAR. What's still missing before the large allocators treat crypto as completely normal?
How much time do we have? I mean,
11:15.
I would say we wrote a market primer precisely for traditional investors just coming into the space to kind of help them understand the different points and also fragilities that came to light in last 1010 very much came to the forefront. So MiCA does help. It does create that regulatory framework for CASP to be able to more easily get licenses. Having said that, investors still have to do their own due diligence. We're still seeing the technical details getting fleshed out for MiCA, and happily that should happen this year, as well as having all the member states on board with the new framework. That should happen this year. So that is very important. It gives that permission for institutional investors to at least start looking at the space. But then, of course, we've got other elements, and I think one of them that's really relevant is having more scale. And for that, you need the banks to more actively participate, more actively use their balance sheets. And here we're waiting, for the Basel Committee. We have the very high risk-weighted asset requirements for crypto, 1,250%, and with a cap on Tier 1 capital. So that really, in order to be able to kind of see ourselves as a peer to other asset classes, we need, institutions need to be able to trade crypto in the same way that they trade other assets. It needs to seamlessly integrate, never mind the fact that potentially everything will eventually go onto the blockchain, but that's another matter for discussion. So we need that leverage, that lending, and also very importantly, structured products. So yeah, I think those two, and of course there's the accounting issues. We need basically a full stack asset class, because that liquidity, that scale is really important, especially as we've seen time and time again, for example, with private credit, more recently, liquidity is ultimately a very important risk metric for institutions.
Okay. Maybe on to Max. I'm sorry to shift the microphone between you all. By the way, if I start crying, that's not because of crypto prices. It's because of hay fever. So don't read anything into it. Max, you're very much on the product side. Martha just said blockchain will eventually take over the entire financial industry. How long do you see until that happens?
Yeah, I mean, if we see from where we started back in 2008 to 2010, where we had these, I don't know, shady magic, darknet, internet money, and where we are right now already, I mean, this is already a great achievement. Of course, we crypto natives thought 2011 in a different kind of way of financial freedom and kind of anarchy disrupting what we're having right now. But we need to acknowledge that the liquidity, where I totally agree on that, especially Bitcoin is a liquidity-driven exotic in asset classes right now. To me, from a product perspective, it comes more how we can drive adoption for especially the institutional side. And if we want to drive the adoption for the institutional side, we need to drive the adoption for the owner and decision maker behind those institutions. And I think there is the biggest gap right now for institutional adoption. We have end users which lacks in user experiences still, because crypto, especially Bitcoin, still has these shady statement, especially in the traditional finance world. But when we think about this longer, the owners of those institutions who should adopt it, and I think the appetite of the end customer who drives this liquidity is already there, But if we don't drive adoption behind those institutions, we're still lagging on user experience. So we need to find and potentially building those infrastructures for single family offices, multi-family offices, and building Bitcoin as well as crypto assets in their expected environment. Because why should someone who is running a multi-family office, and we are sitting in Europe in trillions of assets which are sidelined and can enter the market, why we want to bring them into another ecosystem, why we want to bring them into another company where they can adopt crypto assets, why we don't white label those infrastructures and make it those family offices, etc., accessible. Because if we get the decision maker, institutions will follow. If the institution follows, the bigger retail funds, which are sidelines, follow.
Maybe Lutz, Mäx just mentioned family offices. When you talk to institutional investors, what trends are you seeing currently?
Yeah, I think it goes beyond the family offices, right? I think while maybe a year and a half, 2 years ago, you saw family offices interested in it, and some of them have been allocating 10 years ago already, rightfully so, and of course successfully so. But especially over the last year, we've seen more and more inquiries from institutional investors, and that being the largest pools of capital, right? So that is pension funds, that is other sophisticated investors that are looking into, should I allocate a part into my portfolio? And that's maybe why I was a bit more bullish in the original survey at the beginning of the panel, that there is this interest, and there's a lot of players that are in this ecosystem, not just the allocators themselves, but also consultants that wrap their head around how should they access this asset class, should they access this asset class, and what will it do to their overall portfolio, right? Just adding on to also what Martha said earlier in terms of how they're integrated, well, they all look at their portfolio with respect to risk and return, right? And some of the takeaways that are obvious maybe to us as the industry when integrating crypto into a traditional portfolio, but which was eye-opening for them, was like the return, of course, historically speaking, if they would have had a crypto allocation, would have been better, but the risk would have been, if marginally larger, if not even larger at all. So those are sometimes very eye-opening discussions and what we see.
I just want to add to that because I can relate to it. In the last year, we've certainly seen a sea change in the level of curiosity and knowledge from the very traditional institutions like the pension funds. Of course, the private offices, hedge funds, they're more nimble in terms of their decision making. They can come in and out as well more quickly. But that stickier capital, we have seen a lot more interest. And I wouldn't say that the price action has scared them off in any way, because they're not looking at the short term. And in the words of one trustee in particular, when I asked him why he had come to the meeting, is we have to take a view. We cannot afford to just ignore the asset. We have to take a view. And also, very importantly, the younger members of these pension schemes are coming to them and saying, why can we not get exposure to this asset class?
Adrian?
No, I'm just happy that the conversations are less philosophical. In the past, I had to deal with questions. Bitcoin is going to zero, and I had to make a case why it's not, why the asset class has a right to exist in the first place. So we had to battle through those conversations in the last cycle, while now I agree with Lutz and my colleagues that it's more about allocation sizing, how does it fit into a multi-asset portfolio. So I think it's quite refreshing, and it sets the right direction.
What are the biggest due diligence questions that typically come from institutional investors? And have they changed over the years? Who would like to take that? Martha.
I can take it again. Yes, I've had the same, everything from money laundering to energy. Energy for a while was a big concern. We get the quantum question sometimes, but I think quantum is something that comes up not just for digital assets, it's across the board. So yes, I think the level of knowledge, but we very much work on what is the historical data showing us, and how does it fit into that 60-40 portfolio, and how does it fit? I think investors are now thinking more about the 60-20-20 portfolio. It's something that very much the head of strategy at Fidelity Investments has been advocating for quite a while now, that alternative asset element to Bitcoin specifically. And so, and every cycle that Bitcoin lives through is another strong data point, because the investors need to see the asset class battle tested over different cycles. And for example, what we've seen recently, the resilient behavior of Bitcoin in recent days, despite other markets falling out of bed, and the fact that bonds and equities have been positively correlated, not in the right direction, again underscores this need for a lot of investors to reconsider that traditional portfolio.
There are thousands of cryptocurrencies. When you talk to your clients, do they basically only talk about Bitcoin, ETH, Solana, or anything wider than that?
Well, I think for the more crypto native individual that works in these institutions, there is a focus on Bitcoin. And then there is a focus on Ethereum, Solana, and let's not go too far down that list, right? And interestingly enough, when speaking with the pension schemes and the consultants of them, for them it's still a diversification game, right? Because they come from this traditional world of diversification is key. So they wouldn't feel comfortable with just a Bitcoin allocation, while probably a lot of crypto native investors would feel very comfortable with this, right? So I think it's Bitcoin centered for the ones that have a bit of history, and then it is focused on the established chains and protocols.
Adrian?
Yeah, I would totally agree. And I think I like to be very blunt with some of those traditional investors and be upfront and say, yeah, 99% of all crypto assets are trash and shit. They don't have any value. And it kind of starts building that trust, in my opinion. But the conversations are very much around Bitcoin, Ethereum, Solana. But I think it's also important to teach them that those assets should be treated differently as well. Like a Bitcoin should sit somewhere else in a portfolio compared to Solana and Ethereum, which are much more kind of like an infrastructure play, or are like a tech equity, let's be honest. While Bitcoin really more as that digital commodity. But I think they're starting to get it.
Max, you're very much into tokenized yield and Bitcoin-backed strategies with Teroxx. Are you? How do you sell the product to clients that crypto is more than just Bitcoin and ETH?
Yeah, I mean, I think we should potentially segregate those discussions from a client perspective. They are more or less on an institutional side, more interested into risk return. And I think we are all here in this room can be honest that the market has settled. So, and if we compare this to all YouTube conversations and so on, there is not a second altcoin rally. So if we're talking about Bitcoin, it's the main asset, which also is always the eye opener or the entry point for all what happens beyond. Then we have more these infrastructure plays like Ethereum and Solana, which is then the granular part to make your crypto portfolio round. But I think the knowledge inside of institutions and high net worth and ultra high net worth individual investors rises so fast that they already thinking about, if I allocate a percentage of my portfolio in a crypto asset, they start asking already what happens next, how we can now access what we benefit on Bitcoin with 24/7, 365 a days, how we can copycat this now to traditional assets, why I can't move my Tesla shares on a weekend, why I need to wait for opening hours. And I think this is the next broader discussions we are implementing right now to make exactly the same usability as we experiencing from crypto and other crypto assets right now, and copying this over then via decentralization of traditional assets to make them accessible on a weekend if I want to buy something that I can liquidate them.
Maybe building on this, everybody talks about the, 9 trillion migration of capital to digital rails by whatever the number is. It keeps moving forward, 2030. Deutsche Börse just said this morning 10 years, whatever it is. But as the person building those rails, what are the key bottlenecks? We talked about regulation, but there are plenty of other things that have to be right. What are the key bottlenecks that could still derail this institutional adoption story? Who would like to take this first?
Yeah, maybe I can start pretty quick. I think we still have a user experience problem in crypto. I mean, I'm in crypto since 2011. We need to start it on a terminal and create blockchain wallets directly via terminal codes and so on. Of course, it's an advancement now to do it via an application, but if we're thinking beyond what drives portfolios, how we can increase user experience, especially for the next phase of integrating DeFi or merging TradFi with DeFi. If you are using DeFi right now, it still sucks. So you need to connect something, you need to swap, you need to bridge, you need to go create something on Hyperliquid, then the vice versa, you spend gas fees, blah, blah, blah. And I think as long as we don't erase those friction points, that decentralization, so the technology behind all crypto assets, feels seamless, like you are using Apple Pay or something like this, as long the big capital which want to enter the market sidelines.
Yeah, DeFi feels like building your own Linux kernel, and be very happy with that. Adrian, you wanted to add on that?
I mean, I totally agree on that one. There's always two sides to enter that space, and either one will affect you in the future. It's from an investment angle, so you want to invest into the asset class. And here, obviously, we've seen a lot of progress in regards to institutional grade solutions, ETPs, ETFs, which makes it very easy for them to access it. And the other side is via infrastructure and tokenization. So that's the other way that eventually will all affect us, and we got to deal with it. For the UI UX, it sucks, I agree. Like bridging between L2s on Ethereum. I haven't used Ethereum for a while. Hyperliquid is actually okay, but other than that, it's a terrible user experience. I hope we see a convergence between AI and crypto. I hope those little AI agents, they abstract away from the complexity, because those AI agents, they care about code. That's where they feel comfortable, while we just got a prompt and give an action, and what happens in the back end, that's up to them.
Let's dwell on that, because this AI narrative seems to be a sort of a life raft for the crypto industry. They say, yes, with all these AI agents, they will eventually use a blockchain, they will use stable coins and all of that. What would be the case against that assumption? Who wants to take the different perspective?
I would say an AI agent for like bigger purchases. If my AI agent is planning my next trip or booking hotels, it's gonna use a credit card. I'm pretty sure about that. But for kind of like micropayments, if you want to call an API, if you want to collect some data, where you really have those small microtransactions, I think that's where AI agents could come in. So both will coexist. Will it save the crypto industry from its ashes? It's a good question, but I still think it's a very interesting narrative.
Martha, go ahead.
I just want to add on the tokenization front. From our experience, what it's helping to do is get asset managers through the door to talk about crypto as an investment case, because they're looking at it from the commercialization, distribution side of things. But then there's what does that imply for investing in the tokens themselves, whether it's ETH or Solana? Although, by the way, we really focus a lot more on Bitcoin and to some extent Ethereum, but they're very different investment cases, and the latter is quite complex sometimes for investors that are new to the space, so that takes more time. So that's kind of what we've been seeing with this narrative of tokenization and reality. You know, what we're seeing with the NISA, with ICE, with NASDAQ, all the non-action letters by the SEC and the innovation exemption, for example. That's all boosting interest in the space, and then getting clients to think about, okay, it's not just the recursive speculative loop, which is a pushback that we used to get in the past. There's actually a possibility of utility at scale here.
Who has most to gain and who has most to lose from an increasing tokenization of financial assets? I always wonder, the technology is already there. If everybody wanted to tokenize stock exchanges, this could happen today. Why doesn't it?
Well, you hope that the winners in the end are the end consumers, the beneficiaries of those portfolios, right, where these securities are being held by the allocators that make the decisions, so that there are basis points, which ultimately that's what it will be. There will be basis points that will benefit them, right, in the future in their portfolio, regardless if it's a private wealth portfolio, if it is a pension portfolio, or if it's a portfolio that's backing an insurance company, right? So you would hope that that is the case, and I think that is what the industry is working towards. And the on the other side, it's of course the ones that are being disrupted, so the entire ecosystem of the traditional infrastructure that needs to wrap their head around of what their reason for existence is in that world.
But that should scare the stock exchanges. But they're preparing for a life of tokenized assets. So it remains to be seen if they will actually lose or gain, because people still like centralized solutions.
Yeah, and I believe they're preparing for it, right? So.
No, I just wanted to say I think the issuer will benefit first. I think it's wishful thinking that the clients are the main beneficiaries, but I think the first ones to gain that advantage will be the issuers themselves, to make use of that technology, to lower operational costs. I mean, we've seen this with stablecoins, right? There's a huge debate around the Clarity Act, what should happen to the yield. I mean, Tether, Circle, for now they're keeping the yield, so they're clearly kind of the beneficiary of this tokenization.
Yeah, I mean, this is now a debate which goes on for years, and of course gets tiring if DeFi, TradFi, who is destroying who. I mean, at the end of the day, if we are really looking on this from a product perspective, it's happening right now already. So NASDAQ started already their tokenization project. Kraken has a huge bet with the Wall Street right now on tokenization of assets. They are all building big inventories right now for making this accessible. So the question isn't any longer if we going down the route, it's just of how deep we can integrate these DeFi mechanisms into TradFi cycles right now. And I think the beneficiary of this whole new, I wouldn't say economy, but it leverages how we can multiply numbers inside of those, let's call it predefined database systems, which we are calling money today, because we are at these hard barrier right now. We can't really scale more. Everything is at this extent of the monetary system, the mechanisms, the institutions, the traditional trading ecosystem is at a verge where we say, okay, we can't do more. And I think tokenization of assets to make them 24/7, 365 days in a regulated space under MiCA, Clarity Act, etc., accessible, is then this hardly needed extension, what we need right now from traditional finance.
When you go and see your clients, what is the number one reason you tell them why they should go into crypto, and what kind of percentage are you discussing with them?
Yes, great question. First of all, we never pretend to tell clients, you know, this asset is right for you. We just tell them you need to consider it, given the track record, given the risk-adjusted returns, given the diversification element. However, it's also our job to understand our clients and their needs and requirements. So it's not necessarily right for everyone, for every pension fund, for example. They have different requirements if they're kind of exiting, and this is a position you want to take long term. It might not be viable for them. So that's more of our role. This is what it is. This is why you should consider it as part of a toolkit.
Why should they consider it? Why are you telling them?
Because of the risk-adjusted returns, and because of this change in this 60-40 portfolio that no longer works and hasn't really worked since 2022. So they're not just considering Bitcoin, but also other asset classes for that reason. We don't give a proactive number in terms of asset allocation, but we do, like in the models we run, we do, like everyone else, find that the sweet spot is a small allocation, right? And this applies not just for institutions. We talk a lot about institutions, but there's also, importantly, retail, but a different sort of retail. So we can see it in the ETFs and the behavior that we've been seeing in the ETFs since the sell-off. We've had about $9 billion in outflows, which is really small in the scheme of things. And that's kind of, we've seen an improvement in the last few weeks. It's showing that the behavior of this more traditional investor, where they're allocating small positions and then perhaps are able to add during downturns, and it's behavior that we're seeing in other asset classes, not just in crypto. So I think we have our platform in the US, 40 million retail accounts that are just barely dipping their toes into digital assets. We're kind of just starting to turn on transfer of assets and these sorts of capabilities, crypto for RIAs, for example. So we're very early on in that process, but that retail investor is also important and also has a different dynamic, which is more supportive in this environment. And we're seeing this like building of that base for crypto price, or for Bitcoin's price specifically.
If you say dipping their toes, that means what percentage? And what percentage are you discussing? That's. I really would like to have the question to all of you, maybe.
Yeah, but to add on before answering and giving you a number, I think the conversation usually starts out with like, why should I allocate, right? It is risky, or it seems risky. And especially these days, I think a pretty good answer is if you look at the implied volatility over 1 year of Bitcoin, it's between 40 and 45%, right? If you look at the implied volatility of NVIDIA over the past year, it's between 40 and 45%. If you look at the implied volatility of gold over the past year, it's between 40 and 45%, right? And not even speaking of oil over the last 2 weeks. So here is your answer to it's risky within a portfolio context, because within a portfolio context, risk for you is volatility, right? That's an answer. So therefore, we can come to the next step, that it provides a diversification to your overall portfolio, because the correlation is not 1 to your 60-40 portfolio, right? So it reduces your portfolio risk in a diversified way. And then we cannot tell clients what they should allocate, right? But I can share with you that when speaking to clients, they come to us and they say, we are thinking of, and that is very institutional capital, we're thinking of between 0.5 and 2%, maybe 3%. That is what we are seeing.
You should invest 1 to 5% of your multi-asset portfolio into especially Bitcoin. No financial advice, of course, but usually it's kind of where this kind of range that is interesting. Of course, it depends on the portfolio, and you got to make the calculations. We also lead with the approach from a multi-asset portfolio approach, looking at the risk-adjusted returns, looking at the Sortino ratio, looking at the volatility, how it behaves. I think that's the right way to talk to those traditional investors. Why they should consider it? There's the version that I tell in the meeting, where of course I say the demand for non-sovereign hard assets is slowly increasing in a world where geopolitical tensions are happening. If you ask me in a bar, I go on a full-on Bitcoin maxi rant about that Wall Street has the patience of a goldfish. And for an asset like Bitcoin, which is long duration, you got to zoom out and really think Ray Dalio big picture, because it's not Bitcoin going up, it's debt and money going to infinity. And that's really the simplicity of this investment case.
Max, what's your number?
Yeah, I mean, I'm a product nerd, so for me are all of those allocations just predefined numbers in predefined databases. Of course, if you're asking me personally, I don't drink alcohol, but in a bar, I'm of course a Bitcoin maxi and heavily invested since 2011 and never sold any of them. So I went through all of these cycles, but if we are talking about client data, and I'm very heavily relying for product decisions on data, I think very common sense and also non-financial advice from a product perspective we see on a multi-asset portfolio, because 60-40 doesn't work anymore. I agree with all the speakers here. You need to have a higher risk appetite. And if we compare this to different markets right now, I think crypto is not volatile anymore. I mean, look at gold the last 2 weeks, look at this current year, look at oil the last 2 weeks. I mean, these are the biggest meme coins in 2026. So if we are talking about an allocation from Bitcoin of 10% over an investment cycle of 3 to 5 years, it's not a volatile asset anymore compared to Nvidia stocks, Tesla shares, gold in the last 2 weeks, and so on. And this is what we're seeing in our data sets right now.
Max, where does the share for digital assets come from? Somebody's got to give. So what is being reduced so that people can allocate their funds in digital assets?
Yeah, by Teroxx we see a decrease in everything which is fixed income products or direct fixed yield products, and those then get mostly heavily then converted into risk on assets, so in a tokenized version of a specific share, which is mostly then tech stocks or then direct crypto investments.
Okay. Martha, you wanted to add on that?
Yes, and I just want to add on the point about the 5%. Yes, we
Really
find
close.
we find also on the 5%, above 5% is just too much volatility, too much of a drawdown as well for a lot of the traditional clients. It's not palatable for them. But sorry, I've forgotten the other question.
Well, the question was, where does the money come from? Percentage, and where does the money come from?
We've run both taking out of equities and fixed income. You get good outcomes with both, but you get a better outcome clearly if you take away from the fixed income side.
Okay. Crypto asset conferences are always about predictions. And this is so great about the last question. Is this actually being recorded? Okay, good. It's recorded. So we're gonna play it back. We're gonna play it back next year. So not if, but when we meet again at CAC27, what is the development, the one development that would prove institutional crypto has really crossed from approved exposure to core portfolio infrastructure? Martha, you want to start, or you want Max to start?
I can say the one development.
The one development that you want to see to say this is now has gone from 4, 6 to 2 to 8 on average, I would guess, if we did the voting again.
Gosh, I think this is a tough question because it's a slow burn.
And I remind you, you are being recorded, but you're not under oath, so.
It's a slow burn. I think it's that utility at scale that and we're seeing it now with stable coins, and that because the use of stable coins, traditional investors can understand very clearly the story behind that, and it makes them more comfortable with the space, and that adoption of blockchain rails by traditional institutions, I think, will be far more advanced in 2027, and that's what unlocks that, making investors fully comfortable with the space.
Okay, Lutz?
I'm going to go with a very traditional one, and that is continued education will drive acceptance, right? Because the conversations that we have here today, we've probably had 5 years ago as well. And just by having these conversations, by educating institutional allocators, that is how you will drive acceptance and therefore inclusion in portfolios, right? So if retail made crypto famous and ETPs and ETFs made it investable, then us allocators will make it permanent.
Adrian, just more to the point of how will we know it when we see it?
How would we know it when? Of course, we would see it in price, but also good to know that this is not a safe space that I'm recorded. But I would say back to the discretionary portfolios. I would want to see a big asset manager allocating into Bitcoin or crypto assets via discretionary mandate, but with conviction. And I want to see this on the news as well, clearly signaling that they feel confident. Because like it's always in finance, no one wants to be first, but no one wants to be last. There's a lot of, once we have the first big one moving, I see a lot of them following suit.
Mäx, famous last words.
Yeah, I mean, we shouldn't really care about institutional adoption at all, because institutions accepted these new asset class potentially, but the biggest driver of it is still retail as a whole. And if institutions don't adopt it with what is coming about agentic AI bots, trading systems, etc., we will anyways look back in 5 years, and then the question is not anymore if it's proved by institutions and accepted through asset allocators, etc. Then the verge between where these new economy of what we are doing with DeFi and leverage through agentic agents and building potentially a whole new society in the next 10 years will verge more and more, and TradFi can't keep up with that anymore. And I think if we try to nail this down to a narrative, I think on one hand, we are one step away from one of the biggest blow-off tops in TradFi or in whole financial markets history, but we are one step away from one of the biggest financial disasters like Lehman Brothers in 2008. And if Bitcoin and cryptos can survive the next 2 years, I think it's not a question of if anymore, it's just a question of who has the most of it.
Wow, these are really famous, great famous last words. Adrian, Lutz, Martha, Mäx, ladies and gentlemen, thank you very much.